Coming up in today's show, stocks finished the day higher, putting in the best weekly performance all year, on the back of a weaker than expected jobs report, leading to a bigger repricing in the bonds market, an update on Q3 earnings season, why I think a recession is around the corner, and a look at all the most important charts. Hey, what's up guys? Welcome to the Click Capital Daily Market Show. I'm your host Jared. I'm going to get you all updated on the latest news, data and charts across financial markets to show you what's really going on underneath the hood and put it all in context for you. And I'd like to encourage you to leave a comment below this video with what you think about the market, or maybe something that I've talked about, whether you agree with it or disagree with it. I welcome any criticism of my opinions, and I'm always interested to hear what others have got to say. So please feel free to comment below this video. And thanks to all you guys who hit that like button. I truly appreciate your support. Right, let's get right into it. Another bullish day to finish out the week. This time not as much breadth across the board as we saw yesterday. Did see Apple come off after their earnings, but they actually rallied up a bit off their gap down. I'll get into that chart a bit later on. And we saw the energy sector come off a bit, along with some healthcare stocks as well. And just looking at the daily chart at the S&P 500, every single day this week, we put in a higher high and a higher low and finished green, mostly near the highs and on good volume as well. So it's been a really strong bounce off these lows from last week. We finished Friday at 41.17 on the S&P. We added over 200 points this week, getting back above the 50. Have a stick with me because I'm going to let you know why I think the market may be close to stalling out around its highs that it got to today at 43.70, maybe up to 43.90, and I'll give you my reasons for that soon. First, let's just look at the biggest driver of financial markets today. That was the US Non-Farm Payrolls report. A look at the jobs market, and that came in a lot weaker than expected. Economists were expecting a gain of 170,000 new jobs in October. Actually came in 150,000, and on top of that, unemployment rate rose above expectations to 3.9% as well. And just looking underneath the hood of that jobs report, we can see where the gains and losses of jobs came from in the economy, with the top gains coming in healthcare and social assistance. Not too far behind that was government, which their spending's been helping keep the economy afloat. Construction, 23,000 new jobs. Leisure and hospitality, 19,000. And then some sectors that actually lost jobs. Manufacturing still really weak, down 35,000. Transportation and warehousing down 12,000. IT down 9,000. And the financial sector starting to shrink headcount as well. And even though it's not politically correct for them to say it, you can bet the Fed enjoyed seeing this number of the jobs market coming in softer than expected, as they know that's what's really needed to get on top of inflation once and for all. And they really don't want to hike rates anymore. And like I've been saying for a while, they've been unofficially on pause for a little while now. And we've had a few soft economic data points come in this week, which has got yields dropping. Then after J-Powell's conference on Wednesday, yields started to accelerate on the downside, and that's further extended today on the back of this really weak jobs report. It's been a huge repricing actually, and volatility going on in the bond market. And like I said yesterday, even though we've got some strong structural tailwinds for higher for longer and long dated durations, what can easily overwhelm that in the short medium term is the expectation of a recession. And that's pretty much what the bond market has done today, especially in the short end. We've got the 2-year dropping 3% to 4.84, and a big change in the Fed fund futures. If you've been watching my daily show, you know I look at these numbers every day, and up until 2 days ago, the market's been roughly given a 1 in 4 to 1 in 3 chance the Fed would hike again around December, January, and that's really changed a lot today. The market only given a 10% chance we may get a hike in January, and now actually given a 1 in 4 chance they may start cutting as early as March, with the highest probability of a cut now being in May. And the market is pretty much close to saying 100% the Fed is done, which I think is very likely now as well. Given the weakening jobs market, which has kind of been the last big shoe to drop, along with retail sales and truck shipments, which have been holding up, all other big indicators of a recession are flashing red. From housing permits to profit margins to credit spreads, money supply and the yield curve. And my own unique indicator for a strong signal that a recession is just around the corner has just flashed for the 3rd consecutive month. And my regular viewers will know this, as we look at it on the first Friday of every month when we get jobs data, and that's the unemployment rate, and it's 20-month moving average. So the unemployment rate is here in the blue line. We currently just ticked up today above expectations to 3.9%, and we've got the 20-month moving average at 3.61. And the pattern I've noticed throughout history is when unemployment rate comes really low and then curls back above its 20-month moving average here in the yellow line, that a recession is usually just around the corner, as we can see on my chart in the shaded grey area. And then looking back through history, with nearly a perfect record, the stock market always bottoms after a recession has started. And that's the S&P 500 in this orange line here. So we got a quick recession and crash back in COVID. And that pattern played out. Unemployment rate went really low, curled up above the 20-month moving average. We went into a sharp, quick recession and the stock market sold off really hard. And going back last time, the GFC, same pattern. Unemployment comes really low, curls above the 20-month moving average. 6 months later, we're in a recession. Stock market came off 55% in that time. Going back again to the tech bubble in 2000, unemployment comes really low, goes above the moving average. We go into a recession, stock market bottoms after the recession. And you can look back at this pattern going back in history, and it's played out time and time again with an unemployment goes really low above its 20-month moving average, and then we go into a crash after the recession. And so here we are today at 3.9, currently above the 3.6 moving average, and the stock market's still reasonably high. By no means has done a bad crash or bear market. And looking at a clean monthly chart at S&P 500, one could even argue last year wasn't a bear market, but simply a correction in this 15-year long bull market, and we're currently in the process of putting in a bit of a double top here, with some strong signs that a recession is around the corner, just at a time when everyone's kind of wrote it off as not happening and the stock market's getting very bullish. With a lot of people saying that the rally's already taken hold in the stock market and it could lead to bigger gains. And next year could be even better than this year. As the economy is holding up good, inflation's coming down, earnings are doing pretty good, and we're in a seasonally bullish period of the year. All of which is true because we've got 81% of the S&P 500 having already reported their Q3 earnings, and 82% of them have come in above earnings per share estimates. That's a bit above the 10-year average of 74%. And companies are also reporting earnings that are 7.1% above estimates, which again is above the 10-year average of 6.6%. So doing pretty good in corporate earnings. And that's the first time we've seen year-over-year growth in earnings since Q3 2022. So we just did 3 consecutive quarters of earnings decline. And the bulls are arguing that that's the start of a new bull market with expanding corporate earnings. And that's adding to the optimism in the air currently going on in stocks. And it is a seasonally bullish period. Looking at the current setup, when we finish October down, but we're still up year to date, the average return in the final 2 months of the year is 4.8%, and we're higher almost 89% of the time. Very strong seasonality. However, we started the month of November off on Wednesday at about 4,200 on the S&P 500. And so if the final 2 months of the year come in line and give us about a 4.8 percentage gain, that takes us right to about 4,400 on the S&P 500, which is conveniently right at the top of this trend line that's been kicked off since the 27th of July when we got that bearish engulfing candle. And so here we are at 43.58. We've already almost gained all of the expected seasonality in the first 3 days. Market's gotten really excited here. And looking at this price action in small caps as well, and even micro caps up over 3% today, along with the huge VIX crush, kind of feels like a bit of an unwinding in the market and a bit of a surge higher, which we can see in high yield corporate bonds as well, on top of this big volume. And just like the Fed overdid it in COVID with flooding the system with liquidity, some are saying they may also overcooked it with rate hikes to try and get on top of that rampant inflation. And that's the founder of the market's most famous recession indicator, the inverted yield curve, Duke finance professor Campbell Harvey, who said the long rate is very damaging. It increases the cost of capital, so it makes it difficult for businesses to invest. It craters the housing market with mortgages all of a sudden at 8%. This causes implications in indeed our financial system. Our banks are taking a hit right now, and he said all of this points to weakness in 2024. And something I saw today I thought was interesting was global shipping giant Maersk plunging 18% as they announce a huge job cut of 10,000, saying it was facing subdued demand and inflationary pressures. And I consider this an important indicator of global trade and economic growth because the less goods they're moving around, the less activities going on in the economy. And we can see that in shipping rates. Price of freight and containers, which exploded after COVID and all the supply chain restrictions, peaked out in September 21, absolutely fell off a cliff last year, and we're now actually back down to below levels before the pandemic. And that kind of coincides with one of my favorite indicators of global economic activity. That's the spread between copper and gold futures, which it too peaked out in October 21, and we've been in a downtrend for the last 2 years, and we've actually fallen this year as well in the spread, as copper is used in a lot of economic activity and products and is considered a growth commodity, and gold's a more conservative safe haven. And so this too is pointing to weak global economic growth, which we have seen out of China and Europe, and US has really been the standout this year with its economic numbers. However, it could be the case of US catching up with the rest of the world, opposed to the world catching up with the US. And moving on to another key event in the markets today was the reaction to Apple's earnings yesterday. Even though numbers came in line with expectations, they still saw a slight decline in sales, especially in their categories outside of iPhone, along with China. And they also said they don't expect revenue growth in December, which is the busiest time of year. And this is on top of their 4th straight quarterly revenue drop. And just looking at the price action in Apple, we gapped down to 174, dipped a little bit, but it held and traded up to finish near its highs, only finishing the day down 0.5%. And sure, the mood across the rest of the market probably helped it a lot with yields coming back. But investors got to ask themselves, for a company that's no longer growing, is it worth paying 29 times earnings for it? As that works out to be an earnings yield of 3.44%. At a time when 1-year government bonds are still above 5%, and you can easily earn 5% in money market funds, CDs and term deposits. And because of that lack of growth, that's been reflected in my stock fair value indicator, which looks at future estimates of earnings, the balance sheet and other things to come up with what a fair value for each stock in the world should be. And that's currently got it at $109 for Apple, with the current price 61% above that at $176. And so according to my custom indicator, Apple could be significantly overvalued here, unless it can get back to growth, and its latest iPhone numbers doesn't look all that promising either. And as it is still the biggest stock in the market, with its value at $2.7 trillion, as a lot of people say, how goes Apple, how goes the market, and the NASDAQ? Because not only is it a huge percentage of the index, it's also important for market sentiment as well. So as always, we'll keep an eye on this one. Just looking ahead to next week, getting through the back end of Q3 earnings season. Not much out to start the week. We'll get to hear from Robinhood and Uber on Tuesday, with a few more on Wednesday, Walt Disney, Biogen and a few consumer stocks. Going on to Thursday with a few more and jobless claims. Then not much else out on Friday, just a bit of consumer sentiment. So things will be calming down on the news front next week, after it coming off a big week this one. Just looking at economic data we did get out today, Eurozone unemployment rate also came in higher than expected, 6.5%, as did Canada's at 5.7%. There's the US at 3.9%, with average hourly earnings coming in a bit lower than expected, along with the PMIs as well, getting close to contraction territory around that 50 mark. And that's on top of that softer economic data we got out earlier in the week, has really helped push those yields lower, and the market pretty much saying the Fed is done, which it had done before in March after the regional bank crisis, only for the economy to surprisingly hold up. But let's see this time whether the Fed really is done. And optimism is growing in the stock market. We can see that in the fear and greed index climbing today, almost getting back into the neutral zone at 42. Corporate insiders had been doing a bit of buying over the last week as well. However, they just stepped up selling a little bit yesterday, getting back above purchases. It was a very busy day in the options market, even for a Friday, and not a regular monthly expiry either. Huge 51.2 million contracts traded, and 57% of them calls. And remember, 51% of those options traded expire in 5 days or less. So a lot of people expecting the market to keep going up next week. And we can see that in the put-call ratio, dropping to 0.74. And my custom S&P 500 oscillator, now back in the overbought zone at 61.2. Even though the institutional buying is still slightly bullish at 55.01. Once that goes under 55, it'll go back to neutral. Did get a bit bullish to start this week off. However, I think there's a chance we may stall out around this 4,400 level next week, where we found a bit of resistance on the 17th of October, and that coincides with that trend line down as well. So we'll be looking for the market to stall out around this level next week. And even though it had a lot of bullish breadth and volume come in this week, this still could be just a pullback in this new downtrend started from the 27th of July. We'll just have to wait and see. We may overshoot up to 44.50. However, there's still a bunch of resistance up there as well. Just moving forward through international stock markets, had a pretty good bounce across the board. There's Canada's TSX. UK FTSE actually pulled back on Friday. Germany's DAX advanced a little bit, sitting right at the 50-day. That's been in more of a pronounced downtrend. China's 50 grew a little bit, but still soft. Japan's Nikkei continues to be one of the best performing markets this year, and the Aussie 200 just back above its 50. But that could be coming up to the bit of a trend line as well. We'll just have to wait and see whether we can get above that. Absolute crush in the volatility market this week. Got the VIX now down below 15, and volatility risk premium's actually gone negative. That means the average implied volatility on S&P 500 near dated at the money options is lower than realized volatility, currently at 15.4. And that's been growing since August. So actual volatility in the market's tracking up. Still pretty low at an annualized rate of 15.4%. And just taking you out to a clean weekly chart of realized volatility, you can see last year we got up to 34%, and back in COVID. At one point in March, stocks were making daily movements at an annualized rate of 95%. So you can see actual volatility in the stock market is still quite low, and even more so now, implied volatility like we can see in the VIX. But looking at a clean monthly chart of the spread between bond market volatility, the MOVE index, and stock market volatility, the VIX, we can see that it's still hovering near all-time highs. The only time we were really higher was back in October 2008, and kind of that period going into then. And that was the GFC. The stock market fell really hard and sharp, and so did that spread. And then the stock market bottomed out down here. And so basically looking back through history, the bond market's better at forecasting and pricing the future than stocks, as there's more larger, sophisticated traders in the bond market versus stocks. And so what we're seeing right here is the bond market a lot more volatile than stocks. And with that repricing today, that's pretty much the bond market saying, a recession is just around the corner. But like we saw in the options market today, a lot of people getting excited and stocks buying calls, and many stocks getting bid up quite sharply, especially ones that have been beaten down. We've now got 73% of stocks above the 20-day average, but still more stocks than not below their 200-day average, and only slight gains in net new highs versus new lows. 71 to 12 on the NYSE, and we just managed to beat out new lows on the Nasdaq, 45 to 26. There's that sharp move in high beta stocks versus low volatility, and a little bit of a pullback in the yield curve, but still in a trend towards neutral, and the 30-year versus 2-year just below that neutral territory, and that's another recession signal when we go from inverted to uninverted again. And there's inflation expectations pulling back below the 50-day. And another jump in TLT. We actually gapped up really big this morning after the jobs data, but we sold off and finished on the lows, still up 0.68% for the day. And this could well be the low for now. And a sharp fall in the dollar index, the back of those lower yields, softer economic data. We can see that trend of the strong US economy over the rest of the world for the last couple of months. Have a look at this price action today. Huge volume down on the dollar. Like I said, it could be the case of the US catching up with the rest of the world instead of vice versa. We can see that in a bit of a pop-up in the euro and only a little bit of a pullback in the dollar yen. The yen's still incredibly weak. But that weaker dollar didn't help Bitcoin, still hovering just below 35,000, and didn't really help gold too much either. It was still hovering at its big resistance level as well, $2,000 an ounce. And crude still trading a little soft here above $80 a barrel. Market really not worried about what's going on in the Middle East and is pricing in no disruptions to supplies over there. Even though Hezbollah and Iran are still warning Israel about what they're doing in the Gaza Strip. And over to stock sectors, another little bounce in cannabis shares. We're pretty much green across the board, only two sectors down, energy and oil and gas. And like I said, some really big pop-ups and beaten down sectors, especially overvalued stocks. So we can see that in ARK up another 5.6% today. Retail stocks up 2.9%. Airline jets up almost 4%. Regional banks up 3.6%. And even though gold didn't move higher today, we had a huge bid in gold miners up 4.2%. Another big bounce in a beaten down sector, biotech up 4.6%, and REITs once again climbing a bit higher, but was sold off a bit in the afternoon. Good day for the BlackRock barometer, back above its 50, and Microsoft climbing once again, which, believe it or not, is within 4% of its all-time highs. Google looking to close its earnings gap lower, and we've got NVDA back above the 50 at $450 a share. Climbed a little bit on Tesla, but that was sold off. A little bit of a shooting star formation here. Not sure whether we can fill this earnings gap down, as I think the market sentiment may have changed on Tesla with that really weaker than expected margins. And Tesla will always have an inbuilt premium. It's the strongest brand in its category, does have the best technology and brightest future, etc. However, it's still 700 billion market cap versus 81 billion in sales, and they still generate over 82% of their revenue from electric vehicles. And you compare that to General Motors, 40 billion market cap on 156 billion in revenue. So I wouldn't be all that surprised if Tesla does trade down to a 200 billion market cap over the next year or two. All depends on the market sentiment. I'm a long-term holder in Tesla, but on the back of that weaker quarter and compressing margins, I am a little bit worried about its valuation right now. I'd really like to see that Cybertruck come out and put in some good numbers. Otherwise, at 700 billion market cap, we still may be a little rich here. Another good day for the meme space. And we got earnings out from travel group Expedia, coming in 9% above expectations. Market loved that, up 18.8%. But we recently got earnings out from their competitors, Booking.com and Airbnb, which did come in above expectations, but the market didn't have much of a reaction to those two. Another little bounce up in Walgreens back to the 50-day. See whether this $21 support level can hold. Put in a big bullish divergence on my DSI here. Another climb up in Macy's, but maybe a little technically overbought here. Along with Verizon, which has done a really good bounce since before earnings, now up over 20%. And some pretty good bounces in those vulnerable regional banks. But like I said, on a lot of these charts, we're still yet to see whether they're broken a downtrend or this is just a pullback, which could pretty much be the case of the entire market here. No doubt this was a really strong week on volume. Felt like a bit of an unwinding, uncoiling, maybe some short covering. Definitely a bunch of new bulls coming in. We can see that with a huge amount of call options today, 57%, over 51 million contracts traded, and that huge VIX crush, all spurred on by that big pullback in yields from the weak economic data we got this week, and the market interpreting J as being unofficially on hold, and of course the jobs report coming in a lot weaker than expected, and unemployment coming up a bit higher than expected to 3.9%. The bond market is pretty much saying a recession is 3 to 6 months away, and the stock market can still rally while the Fed is on pause. We don't typically see the big falls in the stock market until the Fed starts cutting rates, because that's normally when things are going wrong and the Fed's having to respond immediately. So the market still could overshoot and we go up to 4,500. But like I said, I'd be surprised if we take out those yearly highs around 4,600. I would say around 4,450 to 4,500 could be another shorting and hedging opportunity if we were to get there. Otherwise, like my S&P 500 oscillator says, we're already into technically overbought territory and we may just stall out at this 4,400 level and trend line next week. We'll just have to wait and see what happens. And kind of similar story in all the other indices as well. There's the S&P 500 equal weight, there's the mega cap 8 bit of overhead resistance, the Nasdaq Qs, the Nasdaq equal weight, and the Russell 2000 could all still be in these downtrends started from a few months ago. And not much out in big earnings and economic data next week, so we'll just have to see how the market trades on itself or any surprises we may get. And that's all I've got for you this week. Thanks very much for sticking with Click Capital and supporting this channel with your likes. And like I said at the start of this video, you're welcome to drop a comment. I'm always interested to hear what others say, and I reply to every single one. Hope you all have a great weekend, and I'll see you again on Monday night. Cheers.